Most traders learn market structure completely wrong. They are taught higher highs, lower lows, break of structure and trend changes. But the problem is that by the time those things happen, the move often already started. So in this video, I am going to show you 3 levels of market structure. Level 1 is what most traders use. Level 2 is what experienced traders begin to position, and level 3 is where traders enter before the crowd even realizes what is happening. Because the goal is not to buy the breakout, the goal is to understand why the breakout happens. So let's start with level 1. Let's first off start with the terms, because everybody names it different, but for me a BOS means a break of structure, and that will mean that we break the structure and the price tends to go in the trending direction. If we talk about a MSS or a market structure shift, I am talking about a possible reversal. Also, we did color code our levels. I will always use white for level 1, red for level 2 and blue for level 3. And also we have 2 rules, and that is we cannot count more than 3 levels. We could count to like 1000, but it doesn't matter. We only need 3. And also the time frame does not matter. So if this is a monthly time frame to start with, we can also zoom in on the daily time frame to find our level 3. We only need proper market structure. So if the market structure on level 3 is not there on the monthly, we can go a time frame lower if we have proper market structure for our level 3. Let's start with level 1. This is the market structure that almost everybody learns. We create a low, we create a high, we create a lower high. We will call this an uptrend. And to the downside, we have a high, we have a low, we have a lower high, and we have a lower low, and now it's called a downtrend. Most traders stop here. They see a break of structure like this, and they immediately enter the trade. The price breaks below previous low, and they will sell. And sometimes this will work, but there is a problem. If everybody can see the same thing in the chart, why would that be the best entry? Well, usually it is not, so it's often the late entry. You are late to the party. Now, I will tell you something interesting, and I want you to think about it. If everybody is buying the breakout or is buying the breakdown, where are people their stops? Well, the obvious answer is below the last low or above the last high. So the market knows exactly where traders place their risk. And that's where level 2 comes in. So level 1 is the main structure, and level 2 is the pullback of the main structure. So obviously we can create level 4 as well inside of level 3, and we can also create level 5 inside of 4, etc, etc. But if you want to create more levels, instead of focusing on level 1, 2, 3 on, let's say, the monthly chart, what you need to do is you just zoom in on this one right here. This will be now your level 1, and you will have a level 2 pullback and then a level 3 inside the pullback. Okay, so basically then you have 4 levels, but you are just shifting your focus from the higher time frames to the lower time frames. So, for example, we have now level 1 in white, level 2 in red, and we have level 3. But still, you want to be more zoomed in. You want a better entry. So what you are going to do, let's make this the example. Now we have our red level 2 is now our main focus. This is our new level 1. Inside of this leg, we will find our level 2. And inside level 2, now we have level 3 like this. Okay, this is the way if you want more precise entries. So what are the rules and why are we using it and how do we use it? What you want to do is you want from each level, in case of an uptrending move, so if your main structure is uptrending, you want to draw a line from your level 1 like this, and you just call it level 1 POS or structure or whatever. I just call it level 1. Then you are going inside the internal structure and you will find the latest high like this. And you call this level 2. Find your level 3 like this and you will go to the latest high and you will call this level 3. So if you have done this, you now know where the market structure breaks are, where the highs per level are. So level 1, 2 and 3 is now on the chart. Why do we do this? Instead of going long after the breakout here, we will find the breakout early. So when we will break our level 3 structure like this, the expected order flow is back to level 2. And if we break our level 2 structure, the expected order flow is our level 1. And of course, if we break level 1, the expected order flow is a breakout or continuation move of our level 1 trend. So if you zoom out on the monthly, it will basically looks like this if we make it white, right? But now, instead of having an entry right here, we already have an entry right here. So we are actually early and your risk reward is also very nice. So what is important to understand, this high right here, it is an high, it will give some sell pressure, but because we already broke our level 2 market structure, this is not important and we will target our level 1 structure high. So we have multiple variations. This is the most basic one. If you are a spot trader and you want to play the trend continuation, you want to buy the pullback, you can use this and be very profitable because you are early in the move. This is basically the same but in a downtrend. So let's draw it again. If we want our level 1 market structure, we find the latest low. If we want our level 2, we find the latest low as well and we call it level 2. And same thing applies here. We call this level 3. So if the price breaks level 3 and we do have a break of structure right here, well, you can already tell by now the expected order flow is to level 2. And if we break level 2, the expected order flow is back to level 1. But you need to understand that if this is all-time low or if this is all-time high, there will be immense sell pressure. And in that case, this high gets a great target for take profit. Why? All-time highs don't break that often and that quickly. Okay, so that's a difference. So for example, if there is another high, this is not all-time high and then this is target. But if our level 1 like this is all-time high, we need to be cautious and take earlier profits. Okay, so this is another variation. Basically, it works the same. Level 1 is the uptrending move. Level 2 is the pullback. But the only difference here is that our level 2 already got its break of structure and level 3 is the pullback of that break of structure. So in this case, we can't break this low anymore. But if we break this high, this will be our level 3 break of structure like this. Stop loss can go below and we will target our level 1 high like this. Of course, if we break heavily, you can hold position, but in 90% of the cases, you need and you want to take profit at this level. Don't be greedy. Okay, so now we are doing the variation in a downtrend. We have our level 1. Level 2 is always the pullback, like you already know. Maybe we swept some liquidity here and we made our level 2 like this. And now we are creating a level 3. If you would look at this chart, would you go long or short before seeing this video? Let me know in the comments. But in this case, we will see a break of structure of our level 2 and another pullback. So many traders will think, oh shit, this one failed the breakout and now we are going lower. This could be a possibility, but then we will need to break this low. So if you see the price accepting above, of course, you will not short and this ID invalidates. But if we manage to make a lower high and we manage to break structure of level 3, of course, this is a beautiful entry and the target here is as well. We will target the lows. Okay, so if you don't know me yet, I am trading Wyckoff models and I am using Orderflow for it. But if you don't use Orderflow yet, you will need to use this method. If you want to learn Orderflow, you can check my masterclasses. It's free to join Discord and you can check it out there. But for now, this is how a proper Wyckoff range looks like. We have a low one, the selling climax. Here we have a spring phase and now we have the third low made right here, the higher low. And this is where we want to execute our longs. So in this case, if we get the levels and we want to find an entry, this is how it works. This is our level 1. This is the main structure, and as you can see, we broke the main structure. So what we will do, we will say this is a break of structure. So most people tend to go in after this break of structure, but this is mostly where traders fail. Why? Think about what I told you in the beginning. The stop losses will be hunted first, and that's why the price gets pushed up, but then most of the times you will see it retrace back down, and the retrace that will create our level 2. So this is our level 2, and we will zoom in and we will look at this, and of course we will find market structure level 3 that will look like this, and now we have our proper market structure. So the things you need to do is you mark out level 3, you mark out level 2, and we marked out our level 1. So the main reason we want to find longs is because we want to play the rotation. The expected order flow after a Wyckoff model is that we rotate back up. In the next videos, I will teach you everything about the rest. I will teach you everything about Wyckoff, and also I will teach you everything about reading the order flow. So you don't need a market structure entry, but you can actually enter right here and just hold all the way up. But if you use this method only, if we see a break of structure of level 3 like this, well, you already know the expected order flow is level 2. And if we break level 2, the expected order flow is level 1. Okay, it's really this easy. But there are a few important notices here. If there is demand below level 3, the stop loss needs to be below. So let's say there is a small demand zone right here. Instead of going in long after the break here and we put the stop below the latest low and we target level 2 and we target level 1, so the trade will be like this. If we see demand below, the stop loss needs to be below the demand zone. Why? This is our stop loss protection. So sometimes we'll see a quick pullback, get the last stops out, and then the price pushes up. This happens a lot. So this is very important that you do this. On the other case, if there is supply above level 3, we need to wait before level 2 breaks. If you don't know anything about supply and demand and liquidity, watch my next videos. I will teach you everything about it. So let's say there is a supply zone right here and it is a really high quality supply. We need to wait before we break above supply. Okay, if we enter here, the chances are huge that the price never breaks level 2 and we don't hit target, and we might see a failed break or a failed accumulation. So this was it for this video. Thank you for watching, and I hope you will see all the videos, and I hope I will see you in Discord. Bye bye. Ciao, ciao.